and welcome to this channel. My name is Nonye and I am your real estate tutoress. On this channel, I bring you the best tips and tools to getting your real estate license here in Illinois. I also answer any questions you may have about the process. If you are new to this channel, welcome and do consider subscribing. Also, if you've been watching for a while and you haven't already subscribed, please do subscribe. Help me grow this channel. Today I have another vocabulary video for you, and this is the financing edition. So grab your notebook, grab something to write with, and let's jump in. Promissory notes. This is your personal IOU. This is the borrower's statement to the lender that says, I owe you this amount of money and I will pay it back to you at this amount every month or however often for a specific period of time. So that is your promissory note. Interest. This is a charge to use someone else's money. And so if you are borrowing money, you're going to be charged for that money that you borrow. For the purpose of mortgages, interest is charged in arrears. Interest is charged in arrears. Similar to your credit card, you use the card, they send you a statement. If you don't pay it in full, then they charge you the interest. So that's the same concept here. Discount points. A discount point is a charge that the borrower has to pay in order to lower the interest rate. So, if we're lowering the interest rate by 1/8 of a percent, that's 1 point. So, 1 point lowers it by 1/8 of a percentage. 2 points will lower the interest rate by 2/8 of a percentage. And then, how much is the borrower going to pay? The borrower will be paying a percentage of the loan amount. So 1 point will be 1% of the loan amount, 2 points, 2% of the loan amount, and it goes on like that. The loan origination fee. Loan origination fee is the fee that the lender will charge you for the process of originating that loan. So their process of originating the loan costs them money, and so they will also charge the borrower some of that. It is calculated as a percentage of the loan amount as well. A mortgage. A mortgage is a document that essentially says that this borrower is pledging their property as collateral or security for the money that they are getting from that lender. Right? So you're borrowing money from a lender to purchase a house, and then you will say, okay, my house is also security for this debt. So if I don't pay this house, if I don't pay the debt, you can probably take my house. A deed of trust is another financing instrument that's used instead of a mortgage. In this scenario, we have a third party who is called a trustee. The trustee will hold on to the title on behalf of the lender. And should the borrower default, the title will go to the lender. If the borrower pays the loan off in full, title goes to the borrower. So that is your deed of trust. A mortgagor. The mortgagor is the person who essentially creates this mortgage document and gives it to the mortgagee. So the borrower is the mortgagor. They're the ones, like I said, when I talked about the mortgage document, they're the one who is signing this mortgage document and saying, yes, I owe you XYZ and my house is collateral. So the giver is the mortgagor, the borrower, and leads us to the mortgagee who is receiving this mortgage document, and that's the lender. So the borrower is the mortgagor, the lender is the mortgagee. Usury. Usury happens when you charge interest that's higher than the maximum allowed per the law, by the law. Right? So if a person charges interest that's higher than what the law allows, they are committing usury. For the purpose of real estate in Illinois, there are no usury laws. Loan to value ratio. This is the percentage of the loan amount to the purchase price. So, how much of the purchase price are you getting as a loan? Okay, how much of the purchase price is this borrower getting as a loan? So, for example, the purchase price is $100,000 and you're getting $90,000 as a loan. Your loan to value ratio would be 90 divided by 100, and then you multiply that by 100 as well, and that will give you 90%. Equity: how much a person owns minus what they owe. So your property's value minus any debt that you may have, and that's your equity. Home equity loan, that's where you're borrowing on the equity that you have in the property. It's usually considered a second lien mortgage, meaning it's secondary to your original mortgage, right? So that is your home equity loan. Prepayment penalty. This is a fee, a fine, or a penalty that a borrower will pay if they choose to pay off the loan sooner. So, how lenders make money is off of interest. So, if you're going to pay that loan off sooner than you said you would, they're losing on the interest. And so, in some instances, there will be a prepayment penalty. If there is going to be a prepayment penalty, it will be told before the loan is closed. So, you would know ahead of time if you have a prepayment penalty on your mortgage document. Alienation clause, also known as a due on sale clause, meaning the loan for that property is due when you're selling it. So it will be a clause in the legal or loan documents whereby if you're going to sell the property, the lender will say that the loan balance is due immediately. Acceleration clause. Think of the word accelerate, all right? So we're speeding things up. In the loan document, in the mortgage document, the lender will stipulate that if a borrower should default on the loan, the entire loan is due immediately. Okay? If the borrower should default on the loan, the entire debt is due immediately. That is your acceleration clause. Primary market. This is where loans are originated or made. So if you need a loan, where do you go? To the primary market. So your banks, insurance companies, pension funds, mortgage companies, credit unions, those types of places. Those will be considered your primary market. And then our secondary market is where loans are sold. So we originate in primary and then we sell in secondary. For the purpose of this exam, you need to be aware of Fannie Mae, Freddie Mac, and Ginnie Mae. Know which types of loans they purchase and know what Freddie Mac stands for, like the full name of it, and Fannie and Ginnie as well. PMI, private mortgage insurance. If a borrower doesn't put 20% down when they are getting a loan, they will be charged a mortgage insurance policy. And this insurance protects the lender against the borrower's default for the first 20 to 30% of that loan. Fixed rate loans. These are loans where the rate is fixed. So look at the word fixed. So fixed rate, the interest rate is fixed. It will not change over the lifetime of the loan. So fixed rate loans versus adjustable rate loans. So look at the word there, adjustable, meaning the interest rate will adjust over the lifetime of the loan. It will either go up or down depending on some economic factor. Package loans. Package loans are loans that cover both real and personal property. So this could usually be seen around new construction property where the builder is not including, for example, appliances. And perhaps the borrower does not have the cash to go buy all the appliances for the home. And so they will wrap that package, right, into this loan. So you have the house, the real property, and the appliances, personal property, all packaged into one loan. Amortization. This is where your monthly payment is going towards interest and also principal to pay down that loan. All right. Amortization, your regular monthly or bi-monthly payments, so your regular payments are going towards the principal, the debt itself, and also the interest on that loan. A buy down. So you're buying down the interest on the loan. You could buy it down temporarily or you could buy it down permanently. So the buy down is reducing the loan, the interest on the loan. Open end loan. Think of this as a line of credit from your lender. So you have this line of credit and you can borrow up until that amount, pay it off, and then borrow again, pay it off. So let's say you have $200,000, you could borrow 50, pay that off, borrow 10, pay it off, borrow 200, pay it off, and just keep going that way. But you cannot exceed the maximum allowed. So on the screen, I also have a home equity line of credit. Some lenders will let homeowners borrow or have an equity, some lenders will allow homeowners have a line of credit based on the equity they have in their home. And so at any point, if a homeowner needs cash, they can borrow on that equity and it's a line of credit for them. Purchase money mortgages. This is where the seller will help finance a portion of the purchase price. So, an example of a case where you might see this is the borrower has secured a loan, but they don't have cash for the down payment. And so the seller would allow them will do a self finance of that down payment so that the buyer can purchase that property. A blanket loan. A blanket loan is one that covers a parcel of land, larger parcel of land, and as this loan is paid off, the lender will release title to the land. All right? So, the lender will give you the money, but they'll hold on to the title. And then as you're paying it off, then they're releasing a certain portion to you. So if you pay half, they give you half. If you pay a quarter, they give you a quarter, and they just keep releasing it till you pay it all off in full. So that is your blanket loan. Construction loans. This is a short term loan that's given to make improvements to real property, to real estate. It's usually given in chunks, so you don't get the full amount at one time. Is dispersed in little portions as you're doing the work on the home. It's also sometimes called interim financing. All right, so construction loan for improvements or construction on real estate, and it's usually given in little periodic draws over time as you're making improvements on the home. The lender will most likely supervise this um, rehab as well. They want to make sure that the money they're giving you is actually going to the home. So, for example, they will give you money for plumbing. So, you finish the plumbing, you come back and let them know you're done. They will send someone to inspect the property. Plumbing has been done. Then they will release the next set of funds for the next step of the project. A wrap around loan. This is where a person has one loan already and now they go to borrow a second, they go out to get a second loan. The second lender says, okay, we're going to give it to you. However, we're going to wrap in your payment from the first one into this payment. So, and then we'll pay that first lender for you. So let's say, for example, you're already paying someone $1,500 a month. Your second lender, you're going to be paying them 500. So the second lender will tell you, hey, give me 2,000. We'll keep our 500 and we'll pay that 1,500 on your behalf. Because they essentially want to make sure that that first lender is always getting paid. That you're not paying that first person, but then only paying the second lender. Right? Hope that makes sense. Let me know if it doesn't in the comments. Sale and leaseback. This happens when a property is sold and the seller rents it back from the new buyer. Right? A home is sold, so there's a sale, and then there's a lease back. Now, here, the seller becomes a tenant, the buyer becomes the landlord of that property. And there you have it, vocabulary financing edition. Hope this was beneficial to you and you learned something new today. Feel free to check out this next video where I talk about more content on your Illinois broker examination. As always, thank you so much for watching, and let me know in the comments if you have any questions, and I will see you in the next video.